The $20,000 retirement mistake 95% of Americans make, and it happens before they even stop working. Stop. Before you circle a date on the calendar and tell your boss you're done, I need you to hear something that could save you $20,000 or cost you $20,000 depending on what you do in the next 10 minutes. There is a silent tax trap buried inside the month you choose to retire. Not the year, the month. And almost nobody talks about it because most people pick their retirement date based on emotion. When the bonus hits, when vacation days reset, when the project finally wraps up, when the grandkids visit, when you simply cannot take one more Monday morning meeting. But here is what nobody tells you at the exit interview. The IRS does not care when you feel ready.
The IRS does not care about your bonus schedule or your vacation balance. The IRS calculates your taxes on the calendar year, January 1st through December 31st, and the month you walk out that door silently determines your tax bill, not just for that year, but for the next 3 years after it. The difference between retiring in January versus July versus December on the exact same salary can be $5,000, $10,000, even $20,000 in total taxes over the following 36 months. Same job, same pay, same retirement savings. Different month, massively different outcome. In the next few minutes, I'm going to walk you through 5 specific ways the month you retire silently changes your taxes, your Medicare premiums, your Roth conversion space, your health insurance costs, and your capital gains rate. Each one operates on a different calendar. Each one has a different look-back window. And if you do not coordinate them, you will overpay on at least 3 of the 5 without ever knowing it happened. Quick disclaimer before we go deeper. I am not a lawyer, not a CPA, not a financial advisor. Nothing in this video is legal, tax, or investment advice. These are educational examples based on current tax law and publicly available IRS information. Always consult a qualified tax professional for your specific situation. Drop a comment right now with the month you are planning to retire or the month you already retired. Just the month. January, March, July, whatever it is. The most common months in the comments will determine which examples I use in the follow-up video. 2 seconds. Do it now. Let us get into it. Number 1. The month you retire determines your federal income tax for that year. This sounds obvious, but the math surprises almost everyone. The IRS taxes you on your total calendar year income. If you retire on January 31st, you have 1 month of salary income for the year. If you retire on September 30th, you have 9 months of salary income. That difference is not just about how much you earned, it is about which tax bracket you land in. In 2026, the 12% bracket for a married couple filing jointly goes up to $100,800 of taxable income. The 22% bracket starts immediately after that. If you earn $120,000 per year and retire on July 1st, your salary for the year is about $60,000. After the standard deduction of $36,300 for a couple both over 65, your taxable income is roughly $23,700. You are deep in the 12% bracket. Federal tax about $2,844. Now imagine the same person retires on November 30th. 10 months of salary, $100,000 in gross income. After the standard deduction, taxable income is $63,700. Still in the 12% bracket, but federal tax is about $7,644. The difference between retiring in July and November on the same salary is roughly $4,800 in federal income tax. Same job, same pay rate, different month. $4,800 gone. But the real cost is not the tax on the salary. It is what the salary does to everything else. Number 2. The month you retire determines your Roth conversion space. This is the one that costs people the most money over a lifetime, and it is entirely controlled by which month you stop working. Roth conversions are taxed as ordinary income. They stack on top of whatever other income you have. If you retire in January, you have 11 months with 0 salary income. That is 11 months of empty bracket space you can fill with Roth conversions at the 12% rate instead of 22% or higher. If you retire in October, you have only 2 months of empty bracket space. The salary already filled most of the 12% bracket. Real numbers. Married couple earning $120,000 per year. Standard deduction $36,300. The 12% bracket goes up to $100,800. Retire January 31st. Salary for the year $10,000. Taxable income after deduction 0. Available conversion space at 12%, $100,800. They convert the full amount. Federal tax on the conversion about $12,096. But that money is now permanently in a Roth, growing tax-free with no RMDs, invisible to Social Security taxation, and invisible to IRMAA for the rest of their lives. Same couple retires October 31st. Salary $100,000. Taxable income after deduction $63,700. Available conversion space at 12%, only $37,100. They can convert less than 40% of what the January retiree could convert. The gap is $63,700 of Roth conversion space lost forever because of 9 months of extra work. At a 12% rate, that lost conversion would have cost $7,644 in taxes. Now those dollars stay in the traditional IRA, grow, and eventually come out as RMDs at 22% or higher. The lifetime tax cost of that timing difference can easily exceed $20,000 on a single year's decision. Did you know the month you retire controls your Roth conversion space? Drop yes or no in the comments. This is the single most overlooked timing decision in retirement tax planning. Number 3. The month you retire determines your Medicare premiums for 2 to 3 years. This one catches people completely off guard because Medicare does not use your current income to set your premiums. It uses your income from 2 years ago. IRMA, the income-related monthly adjustment amount, is a surcharge on Medicare Part B and Part D premiums that kicks in when your modified adjusted gross income exceeds $109,000 for single filers or $218,000 for married couples filing jointly. The 2-year look-back means your 2026 income determines your 2028 premiums. Your 2027 income determines your 2029 premiums. Retire January 2026. Your 2026 income is minimal. 1 month of salary plus whatever you choose to withdraw or convert. Your 2028 Medicare premiums will be based on that low income year. Standard premium. No surcharge. Retire November 2026. Your 2026 income includes 10 months of salary. If that pushes your MAGI above the threshold, you are paying IRMA surcharges in 2028. The first IRMA tier adds approximately $81.20 per month to Part B. That is $974 per year per person. For a married couple both on Medicare, that is $1,948 per year. And that is just the first tier. At the highest tier, Part B alone can cost $689.90 per month, more than triple the standard premium. Here's the critical detail. You can appeal your IRMAA determination. Retirement qualifies as a life-changing event. You file Form SSA 44 with the Social Security Administration and ask them to use your current lower income instead of the 2-year-old higher income. This works, but it requires documentation. It requires filing the form correctly. And most importantly, it requires knowing the appeal exists. The IRS does not tell you. Medicare does not tell you. Your employer definitely does not tell you on your last day. The optimal strategy for most people is to retire as early in the calendar year as possible, so the calendar year income is low, and the IRMA 2-year look-back hits a low-income year as soon as possible. January and February retirements produce the cleanest IRMAA outcome. November and December retirements produce the worst. The mistake most people make is not filing Form SSA 44 at all. They see the IRMAA notice, assume it is permanent, and pay the surcharge for an entire year or longer before the look-back naturally catches up. Filing SSA 44 immediately after retirement can save a married couple in the second tier nearly $5,000. $5,000 saved by filing one form. Number 4. The month you retire determines your health insurance cost if you are under 65. If you retire before you are eligible for Medicare at 65, you need health insurance from the Affordable Care Act Marketplace or from COBRA. The cost of marketplace insurance depends entirely on your income for the full calendar year. ACA premium subsidies are calculated on your household's modified adjusted gross income. The lower your income, the larger the subsidy. Retire in January with controlled IRA withdrawals of $40,000 for the year. You may qualify for substantial subsidies that drop your monthly premium to a few $100s. Retire in August with $65,000 already earned in salary, your full year income is higher, and your subsidy shrinks. You could be paying $500 to $800 more per month in premiums for the remaining months than you would have paid retiring earlier. For a couple in their early 60s, marketplace premiums before subsidies can run $1,000 to $2,200 per month. The subsidy is what makes it affordable, and the subsidy is what your retirement month controls. There is also COBRA. If your employer offers it, you can continue employer coverage for up to 18 months. The catch is you pay the full premium, including the employer portion. That typically runs $500 to $800 per month for an individual and $1,200 to $2,000 for a family. COBRA is expensive, but it guarantees coverage during the transition. The month you retire determines how many months of COBRA you need and how it interacts with your full year income for ACA purposes the following year. If you have made it this far, hit like right now. It tells the algorithm to push this video to more pre-retirees who need to hear this before they pick their retirement date. Number 5. The month you retire determines your capital gains tax rate. In 2026, the 0% long-term capital gains rate applies to married couples with taxable income below $98,900 and single filers below $49,450. Above those thresholds, the rate jumps to 15%. Retire in February. Your salary income is low. Your taxable income after the standard deduction may be well below the 0% threshold. That opens a window to sell appreciated investments in your taxable brokerage account and pay 0 federal tax on the gains. Reinvest immediately, resetting your cost basis to the higher value. Years later, when you sell, the gain is calculated from that new higher basis. You erased years of embedded gains without paying a penny. Retire in October. Your salary already consumed most of the space below the threshold. Little or no room to harvest gains at 0%. You either pay 15% now or hold and pay 15% later when RMDs and Social Security push your income above the threshold permanently. Numbers. Married couple with $40,000 in embedded capital gains retires in March. Salary for the year $25,000. After standard deduction, taxable income is negative. Full $98,900 of 0% space available. They sell, realize $40,000 in gains, pay 0 federal tax, reset cost basis. Same couple retires September. Salary $90,000. Available Sunset space only $45,200. On a $40,000 gain, the difference between 0% and 15% is $6,000. One decision about which month to stop working determined whether that $6,000 stayed in their pocket or went to the IRS. Now let us connect all 5 together. Married couple, both 64, earning combined $140,000, $350,000 in a traditional 401k, $100,000 in a taxable brokerage with $50,000 in embedded gains. They turn 65 and enroll in Medicare in 2027. Scenario A, retire December 31st, 2026. Full year salary $140,000, federal tax approximately $13,000, Roth conversion space at 12% 0, capital gains harvesting at 0% 0. 2028. A based on $140,000 income. Possible exposure depending on filing status. Scenario B, retire March 31st, 2026. 3-month salary $35,000. Federal tax on salary roughly 0. Convert $65,000 at 12%, paying about $7,800. Sell $50,000 in appreciated investments at 0%, saving $7,500. 2028. A based on $100,000 combined income. below the threshold, no surcharges. The difference between A and B over 3 years, approximately 12 to 15,000 in taxes saved, 65,000 permanently moved into a Roth, 50,000 in capital gains tax-free reset, 0 IRMA surcharges. Same couple, same money, same retirement, 9 months earlier. The sixth trap. Nobody warns you about. Estimated tax payments. When you stop working, your employer stops withholding. The IRS still expects payment throughout the year. Retire in March, do nothing about estimated payments, and you owe a large chunk on April 15th, plus an underpayment penalty of 7 to 8% annually. Estimated payments are due April 15th, June 15th, September 15th, and January 15th of the following year. Do a $65,000 Roth conversion in June. You need an estimated payment by September 15th covering that conversion. The fix is straightforward. On the day you retire, set up estimated payments through irs.gov payments. Use Form 1040 ES to calculate quarterly. If you are over 62 and recently retired, the IRS offers a penalty waiver via Form 2210, but it is not automatic. You have to know it exists and check the box. The Social Security interaction. If you are 64 and collecting Social Security while still working, your provisional income is sky high because salary pushes you deep into the 85% taxation zone. Retiree collecting $24,000 in Social Security plus $80,000 salary has provisional income around $92,000. Retire in March, salary drops to $20,000. Provisional income falls to about $32,000. Edge of the 50% zone instead of 85%. That shift can save $1,000 to $2,000 in federal tax on Social Security for that year. The final trap. Your last paycheck. This is something almost nobody discusses. Your last paycheck often includes accrued vacation, a final bonus, or deferred compensation. All of that income falls in the calendar year it is paid, not the year you stopped working. Retire in December. Employer pays out 3 weeks of vacation in January. That payout counts as next year's income, not this year's. Retire in January. Vacation hits in January. It compresses into the same calendar year as your remaining salary. The timing matters for IRMA, for Roth conversion space, for capital gains harvesting. Real example. A viewer retired December 20th, 2025. Assumed her income for 2025 was locked. Employer paid 4 weeks accrued vacation on January 3rd, 2026. That $2,500 plus an $8,000 deferred bonus that also hit in January added $10,500 to her 2026 income. She had planned a large Roth conversion in January at a low bracket. The unexpected income reduced her conversion space by $10,500 and pushed her provisional income higher, increasing the taxable portion of her Social Security. 10 minutes asking HR would have saved her $1,200. The rule is simple. Before committing to a retirement date, get written confirmation from your employer of exactly when every final payment will be made. Salary, bonus, vacation, deferred compensation, stock vesting. Map each payment to the correct calendar year and recalculate. What to do right now. 3 things. First, pick your target retirement year. Model 2 scenarios, retiring in the first quarter versus the last quarter. Calculate total income for each. The difference is your Roth conversion space and capital gains harvesting window. Second, calculate your IRMA A exposure. Check projected income against the 2026 thresholds. 109,000 single, 218,000 joint. If either scenario puts you above, the 2-year look-back means surcharges in 2028. Moving the date earlier can pull you below the line. Third, if under 65, model your ACA subsidy eligibility. The marketplace uses full-year income. Early retirement with controlled withdrawals can qualify you for thousands in premium subsidies. Late retirement with 10 months of salary can disqualify you entirely. And one more thing, if your income drops significantly, file Form SSA 44 with Social Security to request an IRMA A redetermination. Retirement qualifies as a life-changing event. The form is free. It takes 15 minutes. It can save $1,000 to $5,000 per year in Medicare surcharges. Do not wait for automatic adjustment. They will not adjust. You have to file. Drop a comment and tell me which of the 5 timing effects surprised you the most. Just the number, 1 through 5. The most common answer becomes the next deep dive. If this helped, hit like. Subscribe if you have not already. The next video on the 5 things to sell before you retire is going to change some of your financial plans. See you in the next one.